Talking about getting debt and getting investment in your business if it's possible. Do you want it? And the right way to go about getting it. I'm going to give you some examples from my past when I had a tech startup. I was in an incubator, as well as some examples from my client, who's a very successful guy who's got millions in both debt and investment. So to start investment, you're looking at venture capitalists, VCs. This is usually ex-entrepreneurs, guys sitting on like 100 million to invest in companies. Okay, in Toronto, where I'm from, VCs wanted to see you were in an incubator like we were. Incubator meaning like a sort of a house for startups where you get connections, you get various things to help you in exchange for a piece of your potential startup. Okay, they want to see hockey stick traction, okay, which is the curve of your business going like that. That's the revenue curve. It's either like revenue curve or like user curve. They're catching you as you're going vertical, and they wanted to see 25,000 in monthly revenue. We didn't learn that till we pitched like 30 people, and no one was giving us a straight answer. They wanted 25K in monthly revenue, okay? Which we didn't have. We didn't have hockey stick traction. We didn't have monthly, that kind of monthly revenue. We were just breaking even with a good idea. But if we had those things, we wouldn't have needed the VC money. We would have either been able to pay for the exponential marketing ourselves, right? We really just wanted the money for ads. Or we probably would have been able to go get debt from the bank. I wouldn't have wanted to give up 30 or 40% of my company when I had this cash cow that was just throwing off money, and that I could take a mil or two, put it into the marketing, and still be getting like 2x return on that. But the last thing I would want to do is give up a percentage on that. Not to mention, even if we couldn't get debt from the bank, we would have had like 20 grand to put back into the company every month on marketing and just snowball that shit. If you're not in an incubator or have connections in the industry, it's going to be tough to even get in the room with these guys because they have so many people pitching them deals. It's also much more effective to be in a place like Silicon Valley because there's just so much more money available there. Whereas a place like Toronto, there's money, but it's just nothing like America, and nothing like being out in California. So just getting in the room is hard enough if you're not in an incubator in terms of investment. And VCs can afford to be picky because they have the money. They're the buyer. They're giving away money. Okay, that's what everyone wants. So they can afford to say no to 100 companies. They can say yes to 1 out of 100 already profitable companies, right? With good ideas, with good founders, already profitable. A lot of the time they can have all three of those things, and the VCs are still saying no to them. Okay, because they can afford to do that. They're sitting there with the money. A lot of the time a VC is run by like ex-entrepreneurs who are already successful. They've got money, they've got investment in their fund. They don't need you. And they don't want to have to take a risk, which makes sense, right? Why take a risk on an unprofitable company when you can already go in on a profitable company? Or maybe it's not profitable, but you can see like hockey stick traction on users, like there was with Facebook, So it's either hockey stick traction on money or hockey stick traction on the amount of users that are coming into your company. And what they wanted to hear was these big revenue projections. They weren't interested in a company that was looking to do a couple million a year like we were. That wasn't exciting to them. And this is because they've got hundreds of millions of dollars. And they know that 90%, even like investing in the best companies, 90% of these companies are going to fail. So they need to hit big winners on the companies that actually do succeed, right? Let's say you have $200 million and you know that like half of that is gone, right? It's going to be spent on companies that don't make your money back. Well, with that remaining 100 million, you're going to want to hit, a company that's going to give you $1 billion back or more. It's a home run situation. At least this is what we experienced. Your experience might be different. Some people might tell you different. I'm definitely not the foremost expert in dealing with these companies, but that's what we've experienced. Like, our advisors eventually were telling us, and this girl I went to school with who became a VC was like, don't tell them anything less than 100 million. So we had to change our pitch a little bit. Okay. And this has been reinforced to me by a client who's very successful, who's secured millions in financing. He said that VCs operate more like entrepreneurs because they're run by ex-entrepreneurs than banks. So they're interested in the dream. They're interested in a charismatic founder. They're interested in a big vision. They're interested in people they think are going to be home run hitters, and who can give them that big ROI. Okay, getting debt, talking to banks, totally different ball game. Completely opposite situation. My clients also secured millions in debt from bankers, and that pitch is not about dream selling whatsoever. Okay, it's about consistent revenue over time. Again, the banks ideally would like to see that you have a profitable business already. Although it's not necessary. They will give you a loan to buy a Subway or something, which is a terrible idea, which I'll cover later. But they will punish you for dream selling. They don't want to hear that you're gonna build the next Facebook. Okay, these guys are bean counters. In their mind, that's equivalent to flushing the money down the toilet. They want to hear you're cash flow positive already, and you're gonna take that money and spend it on doing exactly the same shit that you're doing now, just more of it. You're not trying to do a bunch of different things. You're not trying to buy a bunch of different non related businesses or whatever. It's like, okay, you're selling residential real estate, you've got a branch, you want to open a second branch in another wealthy area on the exact same model, literally doing the exact same thing, and more branches to come in the future, and you want to magnify, and you'll already be succeeding regardless, but if they give you money, you will succeed faster, make money faster, be able to reinvest it faster. That's what they want to see, right? A business in a big market with a lot of demand, with where you're already making money, okay? And you're going to keep doing the same shit. If you look, it's a lot of what Warren Buffett does. He invests in these cash flow businesses, with some type of a moat, run by good people, that he can see another 10 or 20 years of cash flow from it. Simple products, basic as well, like, hey, Coca-Cola or whatever. So bank officers don't like risk. They're bean counters. They're not ex-entrepreneurs like VCs. They're corporate guys. They're bean counters. They were probably math guys in school. They don't like risk. They just want their 6% or whatever the interest rate is returned back to them over the next decade. And they also want to build a relationship with someone they can loan more money to over time and can count on you to pay it back. Okay? They would love to build a relationship with someone like you if they know that they can loan you $2 million to start, and then $5 million, $10 million, 20, and you're just doing the same shit and just keep paying that money back, keep being profitable. Okay? Because that is really the only area where they're similar to venture capitalists in terms of they have revenue targets. Okay, and this is because they have shareholders to please. They have revenue targets. They have billions of dollars on the books. They have more than VCs do, which means they need dependable people to loan that money to, because they have literally billions of dollars to loan out. Their primary business is loaning people money, right? Loaning you money at interest, getting it paid back at a higher rate, making a difference on the spread. That's what makes these banks billions of dollars. That's what they need to do with their capital, okay? And they need to be able to do that at a minimal risk, with billions of dollars. And that's what kept a lot of these businesses or banks in business for the last 200 years. Like the big four Canadian banks have just literally been doing that for the last 200 years, with the exception of, a lot of these banks have got caught up in derivatives and all this other dumb shit, but they've got a great business model. They don't want to fuck with it.